We all want to hit that millionaire mark as fast as possible, and when it comes to investing, two names dominate: ETFs and mutual funds. But if your goal is serious long-term wealth, which one actually puts you on the fast track? Here is the key difference: ETFs, or exchange-traded funds, generally win because of one word: cost. Mutual funds, especially the actively managed ones, often carry higher annual fees and are structured in a way that can trigger unexpected taxes. Those little fees chip away at your returns year after year, slowly starving the powerful magic of compounding. ETFs, conversely, are typically passively managed, meaning lower fees and greater tax efficiency, which allows more of your money to stay invested and grow. For long-term investors, whether you are 17 or 50, those tiny cost savings and tax advantages compound into hundreds of thousands of dollars over time, making ETFs the secret weapon to reach $1 million faster. Stop letting fees eat your future money. If you want the full breakdown of low-cost funds and the exact ones I use, hit that follow button now for more insights.